We'll get this show on the road. We don't meet often, so when we meet, everybody's excited. We have important information to go over. Motion on the quorum, he said. How about that? I ask the secretary, please call the roll.
Senator Rocky Adams. Senator Chambers Armstrong. Senator Douglas.
Present.
Senator Elkins.
Present.
Senator Gardler.
Here.
Senator Howell. Senator Rawlings.
Here.
Senator Smith. Senator Storm. Representative All.
Here.
Representative Bauman. Representative Bray. Representative Camuel.
Here.
Representative Klines. Representative Duval. Representative Gooch.
Here.
Representative Gordon. Representative Grossberg. Representative Hampton. Representative Hancock.
Here.
Representative Heverin. Representative Lewis. Representative Lockett. Representative McPherson.
Here.
Representative Pollock. Representative Rudy. Representative Smith. Co-Chair Carpenter.
Here.
Co-Chair Meredith.
Yes, ma'am.
All right, appreciate that very much. We do need to make some approval of the September 16th minutes. Do we have a motion on the
Motion for approval.
and a second? Second. All those in favor signify by saying aye.
Aye.
Looks like they are approved. So we have a pretty full agenda today, as always, so I'll go ahead and get started. It looks like our first agenda item is the Department of Insurance update with Ms. Clark. I know you have several guests with you, Ms. Clark. Always good to see you. I'll have you all come to the table and just introduce yourself for the record, and we'll let you guys get started.
Good morning. Thank you, Mr. Chairman. Good morning, committee members. Sean. I'm Sharon Clark, Commissioner of the Department of Insurance.
I'm Sean Orm, Executive Advisor to the Commissioner.
Thank you all.
I know you've got a hectic agenda, so I'm going to kind of pare down my presentation here without some of the numbers and whatever, but I'll maybe give some that's of interest. I like to give, I call it the state of the department, to try to give you all an update and compare some figures to where we've been in the past. Local government premium tax. I want to bring that to your all's attention. I don't know if you all are familiar with that, but Kentucky is one of 6 states in the country that has the option for local municipalities to put a tax on the insurance premium. It's a lot of headaches for the companies, but it has been very lucrative for the counties. Last year in 2024, there was $508 million that was available for the counties and the cities that have this program. And I will show how that's grown. In 2023, that total was $448 million. So this is a large source of income for our local governments and municipalities. The premium volume in Kentucky, I do not have 24's figure, but this is the amount that is spent in insurance premiums just in Kentucky. And in 2023, that total was slightly over $37 billion. So that gives you an idea of how big the industry is here in Kentucky. And that has grown from in 2022, that was $35 billion. So some of these figures, and I'll tell you why they're important as we continue. The licensing, this is the licenses for adjusters, brokers, PBMs, all the different entities that we license. Currently, we're tracking 375,000 plus licenses, and that includes continuing education requirements, what have you. That figure in last year at the same time was 355,000. Now, I give you these figures to show that our premium is increasing, our licensees are increasing, and that is another indication of the stability of the market here in Kentucky, even though rates are high, but people are wanting to do business in the companies and also the agents. Our Consumer Protection Division, as of 9/30/25, we have received 14,468 complaints, and we have recovered close to $10 million on behalf of consumers across the state. Now, I'd like to spend a little bit more time talking about our fraud. Unfortunately, fraud referrals are up, and this year we have received 2,182 referrals of fraud in the state. Currently, we have 66 open cases. As of last year, the same investigations are going on. We're still having a lot of the schemes with contractors falsely inflating the cost of repairs, tree removal services, roofing scams, and I think a lot of you all familiar with the roofing company that was operating in Lexington. And they're misleading the consumers on this, and obviously it has an impact on the premium prices. One of the difficult issues, and I told you this last year, and I'm going to say it again, is that our fraud investigators do an outstanding job. They are scattered across the state. They have full police authority. When they receive a referral and they work a case, they put together what we call a prosecutor's notebook that has all of the pertinent information, the interviews, all the evidence, and then they will take that to that local Commonwealth attorney or the local prosecutor. And it's becoming more frequently, particular in the urban areas, that they will not take the case. They will not pursue it. And I think sometimes it's with the dollar amount. They might have bigger cases, but quite frankly, I think fraud is fraud, and as long as it's allowed to perpetuate, it will continue. So that's one of our biggest frustrations, is that we put together the cases, we have the evidence, we have an open and shut case of fraud, and then we cannot get the prosecution of that crime to take place. And as you all probably have heard from the National Crime Insurance Bureau, it's estimated that insurance fraud is a $308 billion industry, for lack of a better term, in the United States, and that it costs each policyholder maybe up to $900. It's broken down into two categories, what we would call hard fraud and soft fraud. Hard fraud is where there's deliberate acts to falsify insurance payouts, such as staged automobile accidents, and that happens quite frequently in the urban areas, where you might have a group of people in a car, they slam on the brakes, and then the innocent person hits them, and then we have claims against PIP, we have claims, and it is it's a technique, and it just so happens that they usually have 5 or 6 people in that first car loaded up so that they can all make these claims. The other kind of fraud that we have is more what we call soft fraud, and that's where there's the exaggeration of a legitimate claim to receive a larger payout. And I'd like to give you one example, and this goes back to the days of COVID. We had some body shops that when they were working on cars, that they put additional charges on the bill for bacteria extraction, COVID extraction, and they were billing the insurance companies for that. So that's just one example of that type. I do have some good news before I give you the bad news, so let me start out with the good news first. Our workers' compensation rates, we just approved the filing. They will be decreasing next year for the 20th consecutive year, and they will be decreasing 9.7%. So that is really good news for the employers across the state, and I applaud all the efforts that the employers have taken in safeguarding their employees and in lowering these rates. Let's continue talking about rates with our property insurance marketplace. I talked about this a lot last year, and we are still in that situation that we are in what we call a hard market. There's just still, the storms keep coming and coming. In Kentucky, the problem is tornadoes and the convective windstorms, and then to some degree flooding that we have. It's been a difficult time for our insurers on there. The huge losses that we've had. There's economic downturn on investment rates that adds to it. Social inflation, such as increased litigation and larger jury awards, add to the cost. the reinsurance that the insurance companies obtain to help cover with the claims. It is stabilizing, but you have to realize we are in a competitive nature with companies all across the world. In 2024, the global insurance property losses was $154 billion. And 76% of that, folks, was here in the United States. And that was the 27% above the 10-year average. So that gives you an idea of the reinsurance costs. So the United States companies are competing with companies in Europe, in Asia, and across the world for this reinsurance. Again, rising labor costs, inflation, labor shortages, scarcity of materials, all of that leads to the increased costs for the insurers and the increased premiums. I will tell you, though, I'm very proud of the fact that our insurance marketplace, I mentioned earlier, was stable. And a good canary in the coal mine I have for that is what we call our FAIR Plan, Kentucky FAIR Plan. It's the market of last resort. When people cannot get coverage through the traditional market, they can get it through the FAIR Plan. And the FAIR Plan only has 340 policies in the state. So coverage is available and people can get it. I will contrast that with the state of Florida. The state of Florida last year had over 1 million policies in their FAIR Plan. So again, that's another good indication of the stability of the market. I'll go to our last most difficult topic, and that's going to be the health insurance rates for 2026. I'm sure you all have seen this in the news, and it's going to be a difficult time for folks. I will tell you that of the 4.5 million population in Kentucky, only 330,000 people have commercial market. But we will be having 3 companies offering coverage over the exchange next year, and those are Molina, Anthem, and WellCare. I did have one company, CareSource, that withdrew from the Kentucky marketplace and will not be offering. So here's the bad news. Kentucky's overall rate increase in health insurance for 2026 will range from 16.1% for Molina, 23% increase for Anthem, and a 37% increase for WellCare. These rates were submitted, and with all of these rates, I send those to our actuaries for an independent analysis to determine if they are excessive or if they are unfairly discriminatory. And our actuaries came back that the rates were submitted fairly. This is a problem not just in Kentucky. It is across the country, folks. And let me give you a comparison. Last year, the average increase for health insurance was 5.5% increase, and now we're up in the double digits. So let's look at some of the, and I will say the small group market also will be having an increase. It will be 18%, and we have 4 companies offering there. So let's look at some of the cost drivers for this. That was my first question.
Sharon, just
Yes.
so nobody falls asleep here. We're all kind of not moving very well, looks like. We might have to get up and do jumping jacks or something. But did you say that this, I just want to make sure I heard you right, 335,000 people of the 4.6, I'm going to use that number, is all that has commercial insurance?
330,000, yes,
Yeah,
sir.
and everybody else has got either Medicaid or Medicare?
Or ERISA plans where they're self-insured.
So that's like over 4
Yeah.
million, we're saying?
Yes.
Commercial. Okay, I just making sure I heard that number right.
That's correct. So the cost drivers, after I got these rates, after I kind of gasped and caught my breath, I asked the insurers, and I asked the actuaries, I want you to drill down where I have specific information on what's driving. So in Kentucky, the main cost drivers are, first of all, the healthcare costs are increasing with the hospital stays, the doctor visits. Particularly in Kentucky, one of the big cost drivers are the specialty drugs. And I don't know if you all are familiar with that, but those are the high-cost drugs that are used for cancers, autoimmune disease, weight loss. It's and also with the use of these specialty drugs, there has to be close monitoring by the doctor or the hospital, so that requires more visits there. The increasing use of technology and with the prescription drugs, it has been a large cost driver. Another one is a term that we call morbidity, and that just means sickness. And Kentucky is it is an unhealthy population that we have in this. Our citizens have health issues, and that means the usage, the drug cost, everything goes up. There is also, there was a national study that was done with my national organization, and they also cited cost drivers such as clinical workforce shortages, the shortages of physicians and the shortages of nurses across the country, and also provider consolidation where hospitals are merging and practices are merging. But the largest cost driver by far is the enhanced premium tax that's been on the news. That's due to expire at the end of this year. It is our understanding that there's approximately 90% of people on the exchange that are benefits of the enhanced premium tax credit. And when that goes away at the end of this year, we are going to have a lot of uncertainty in the marketplace. Our thoughts are that the younger, healthier population that have fewer costs will be leaving the marketplace. They will be going uninsured. And as a result, that will leave the sicker, the older population that really needs this care, and it will be a smaller, what we call risk pool. It will be shrinking. Again, that is not just an issue in Kentucky. And just speaking briefly to that, we have anticipated as an association that there was going to be problems. And starting back in January of 2025, our National Association, the leadership started contacting Congress to let them know about this issue. And we have, I think, sent at least 4 different letters telling them that what impact it's going to have on the health market. So, I'll just close it up with this, and then certainly any questions and answers. I've got over 13 years now as commissioner. I've got the gray hair, to prove it, but and show it. But the markets fluctuate. They go up and down. The last time the health insurance market was in this status was back around 2018-19. And the markets will stabilize themselves. But it is a tough ride when we are having these large increases, and it's a tough ride for everyone. The last thing I'll say is I want to thank you all. I think Kentucky has become notarized for leading a lot of efforts on insurance fraud legislation. I know the public adjuster bill that we passed a couple of sessions ago, Representative Pollack, I think you took leadership, and that became the INCOIL model. Our legislation we passed has also become the model legislation for the National Association of Insurance Commissioners to be, passed in other states. You all also took efforts toward towing and storage cost gouging. So the National Crime Insurance Bureau has been quoting Kentucky as a model state for the steps we've been taking. We can't do anything about the storms, but if we can help do some stuff with insurance fraud and preventing that, that might have an impact on the rates. So, Mr. Chairman, that's, if there's any questions.
There is. You did a good job. There's several questions, so we'll get to those. Co-Chair Meredith.
Commissioner, I appreciate you coming, and I appreciate your talk about insurance fraud and the issues there, the cost. And one of the things that you mentioned was the prosecution side of this and the challenges with that. Could you talk a little bit more in detail about what you see as the challenges related to that are? I know you've got an insurance fraud investigation division within the department. where is the disconnect there, and how does that process happen?
Well, there are requirements in statute that if an insurance company is experiencing fraud, that they have to report it to the department. And we're talking about there is fraud in other lines of insurance, in health insurance, but by far property insurance is the largest. So the insurance companies are doing their job. They have their own special investigation units. So they do a lot of the investigations as well. And we work closely with them. And then we take it over with that referral and do our job of investigating. And then when we have like I said, our notebooks ready, we approach the local prosecutors in those counties. And usually we're not having problems in the rural areas of the state. The rural counties are usually cooperating with us and taking that and pursuing it. And quite frankly, I hate to say, but in Fayette County and Jefferson County, we're not having as good a luck there.
One real quick follow-up. So with the level of the dollar amount, most of those are Commonwealth Attorney's offices, I would assume, or is it mostly
Yes,
a
sir.
Commonwealth Attorney's issue or a County Attorney's issue?
It's Commonwealth attorneys.
All right. Thank you very much, Commissioner.
Not to call someone out, but it's Commonwealth attorneys.
Representative All.
Thank you, Mr. Chairman. I've got two quick questions. Thank you for your many years of service, Commissioner Clark. When you talked about the number of Kentuckians on the marketplace versus the number on Medicaid and Medicare and the ERISA plans, could you kind of high level, 4.6 million to the chairman's comments there, how many are basically on workplace or ERISA plans? Do you have that general number?
I don't have a general number, but I think there's been estimates of like 1.3 on Medicaid, and then, of course, there's the K-CHIP program
Right.
as well. So I don't know if you do the math then and you substitute that, but, I don't have a definitive number because I do not have any regulatory authority over those.
Okay. So it's safe to say there's probably 2 million-ish Kentuckians on ERISA or workplace type sponsored plans. Ish.
I think that is a good estimate,
Okay.
but you're the math person, Representative All, so I just cannot really attest to how
All right,
many.
my second
I will
question.
tell you this,
Yes.
last year was estimated that 5.3% of Kentuckians were uninsured.
Okay.
So you'll have to take
That
that math into consideration.
On the increases for the three companies that are still in the marketplace, that is aside from the increase that the constituents would have if the healthcare subsidies also expired. So if you take, it would be a two-part increase, right? Both the increase for the rate themselves and the increase for the expiration of the tax credit, the offset there. So do you have a general estimate how much that would be compounded together?
It all depends on other rating factors. There's rating factors of age, it's, I would be remiss if I tried to guess that, Representative All.
But for the
It will be
it
a
is
double whammy.
compounded. So
Yeah.
for someone on WellCare, they're going to get a 37% increase on their WellCare plan, and then they'll also, lose that other tax subsidy benefit. So it could easily be a 50% increase on that one particular plan.
They will be subject to both.
Yeah. Okay. Thank you.
Representative Smith.
Thank you, Mr. Chairman. A couple of questions real quick. How long have you been involved with insurance as far as understanding it? About how many years?
Well, I've been with the department over 18 years total.
In your time, since Obamacare came in, they was told it was going to drop rates in half. Have you ever seen a drop in rates since you've been in?
Yes, sir.
What was that percentage? When did it take effect?
Well, Representative Smith, that was several years ago. But like I said, that the marketplace fluctuates. And just the fact that it was last year's average was 5%. I know there have been previous years where we've had higher
The
rates.
reason I was asking, I haven't had anybody in my area tell me when this Affordable Care Act or Obamacare, whatever, that their rates went down, that they saved 50%. I've never heard of a rate reduction when they was going for their insurance reason. I was asking with your expertise. But the other thing was, you said 9% is going to be affected by the tax breaks. It'll be
90%
90% will be affected. Okay, and that 90% of those are paying now?
90% of those are eligible for the enhanced
credits?
premium tax credits. Yes, sir.
Okay, so that rate you anticipate to be what? Do you expect it to double, triple, quad? I mean,
Well-
what is your expert opinion on the effect that it's going to have on the payers?
90% of the people on the exchange that receive this tax credit will go away, and they will no longer have that benefit. Then they will also have the increases that I cited today. And Representative Smith, it's the individual person. Health insurance is individually rated. There's a lot of factors. The rates are higher for that 55 to 64-year-old age bracket than they are for the 30 to 40.
Right,
So,
just right after the COVID, when people were encouraged to get on Medicaid, what percentage did you see that fluctuation due to? Because I know.
Yeah, I know.
I feel like the cutback is trying to get to pre-COVID numbers, trying to get back to where we were before. So that is the goal, I believe, in Washington and also with a lot of people here in the state, in the legislature, is trying to figure out how to get a grasp of it, get back to the pre-COVID numbers. What is your anticipation on that seeing that being able to take place? I mean, that's what affects our insurance costs also in the private, is for the ones that pay, is who's eligible, who's not eligible. And the only reason I ask is because I know the fire alarm's been pulled. I know Washington's shut down over this issue. So, I know there's a lot of panicking going on. And so I'm asking you that question, maybe you can clarify that what the options are, what we need to be anticipating, and what we should look for, I guess, with your background here in insurance.
well, the Medicaid eligibility and all of that is with the Cabinet for Health and Family Services, so I don't have any statistics on that. I do know that there were some people that had previously been on Medicaid that with the advanced premium tax credits, they were eligible to be in private insurance. But with those tax credits going away, I think it's going to be pushing them off the marketplace as well. So I mentioned the word uncertainty. It's uncertainty for the health insurers, and I think all of us in this room, I can't predict what's going to happen, Representative Smith. I'm sorry, but are people going to make choices and cut budgets so that they can get their health insurance? I don't know. It's just a lot of uncertainty, and that is got everyone as regulators and the companies as well. We just have no idea what's going to happen.
Representative Smith.
Thank you, Mr. Chairman. Yes.
Oh, was you done?
Yeah, I
don't want to go back and forth too long because I've got 5 or 6 other people. We're going to go way too long. No, it's okay. But
I was just trying to answer questions that I'm getting.
I know, I understand.
Trying to figure out where
and we can send them offline too,
Yeah.
because there's plenty of them. Because I do understand that, but I don't want to go too long because we got 5 or 6 other people. And we're going to go to.
Thank
If
you,
we go
Mr.
past lunch, we're going to have some people getting upset here. Thank you, sir. Representative Bray. Let's keep it to a couple guys.
Just got one.
Yes, sir.
Thank you, Mr. Chairman. So the Attorney General issued an opinion on Senate Bill 188, the PBM bill. Will you all be issuing any new guidance or making any changes to your enforcement?
Representative Bray, our attorneys are still reviewing that matter.
All right, thank you.
Representative Gooch.
Thank you, Mr. Chairman. I'll try to be brief. Of course, I came here right after the Kentucky's version of health care reform, and we had 48 insurance companies, and I think about 44 of them left the state or whatever when that happened. And so most of our decisions on health care haven't been very good. But I'm a little concerned that sometimes we act surprised. I mean, we know that, as my colleague mentioned, nothing about the Affordable Care Act was affordable. And so what happened is we had a lot of people in Kentucky that actually went on Medicaid as their way of getting health insurance. And at that time, there were subsidies, and most of those probably were talking about a sunset date where those subsidies would go away. They never did. And then we had COVID come along, and the majority of a large number of Kentuckians got coverage on Medicaid again. It was the expansion of Medicaid that allowed those people to get coverage, again, with subsidies that were supposed to at some point go away and never did. I mean, COVID's been 6 years ago. Affordable Care Act's been way longer than that. And we kind of get surprised when we find out that, hey, these subsidies were never intended to last forever. Now, I realize there's going to be a lot of problems. A lot of people are going to be hurt. And I predict that there may be some negotiations, if we ever get the government reopened, that might look again at some of these subsidies. And I kind of hope that does happen, because hospitals will be hurt, patients will be hurt, a lot of people will be hurt. But we have to understand that you can't put subsidies and giveaways into these programs and never expect that they're not going to go away at some time. Thank you, Mr. Chairman.
Thank you. Senator Elkins.
Thank you, Mr. Chair. So to go back to the fraud issue that we're experiencing, and no doubt there's a lot of it that goes on, I understand, and getting the Commonwealth attorneys to prosecute or lack of, is that because of the time it takes to prosecute? Is it because of the court systems? Is it because there's no real teeth in the penalties? What do you attribute that to? And a follow-up question, does the Attorney General's office ever get involved? And where do you see we can go to improve that? Because it really is an issue that our insurance companies are dealing with, this fraud, and not doing enough to stop it or to prevent it, because if we don't prosecute it, it's going to continue to happen over and over again. And so I guess that's where I'm trying to go with that. Thank you. Thank you, Mr. Chair.
Senator Elkins, I have not had conversations with the Commonwealth attorney, but what they usually tell my investigators is that their workload is so heavy and that this is a lower dollar amount. Mrs. Jones' $2,000 fraud on her roof is a lower dollar amount than maybe other crimes that they have to prosecute, and so it just is put in a list of priorities. You have asked me, now the AG is not involved in Kentucky, but there are several states across the country where there is an AG prosecutor that is assigned directly with the departments of insurance, and they work with doing the prosecution of those fraud cases.
Thank you. Thank you for being here today. I appreciate that.
Thank you, Senator.
Senator Douglas is our last one.
Thank you, Mr. Chairman. Thank you so very much, Commissioner Clark, for being here. It's always a pleasure to have you here and learn from you. I just wanted to say a couple of things. And I want to address the insurance cost. And I think a lot of people don't realistically look at the fact that it's all based on risk. It's based on risk. And, we have two issues when we talk about the healthcare space and insurance, and that is those who actually do or don't have insurance, and then we also have those who pay into the pool of what we call the shared risk cost. So I think some people think that there are insurance groups that pay here and there are some that pay here, and they don't recognize, no, there isn't. It's a shared risk cost. So if we actually have fewer people paying into the system, covering more people, then the price goes up. The price goes up. I'm working with some folks on more of a health accountability model that is a patient health accountability model to help reduce some of the rates, not just look at the doctors and the hospitals and the other healthcare providers, including insurance, but a patient accountability model. So my question ultimately is, when we look at our healthcare system, isn't our healthcare system mainly meant not to make people healthy, but to supplement and maximize their health state? Or did I talk too fast?
No, I was just, I have a daughter who is a physician, Senator Douglas, and I think I'm looking at it from my family's perspective, is that our providers are there to address and try to assist the patients with their health care, whether that is an improvement in general health or is in addressing a particular condition that they might have.
But ultimately, isn't that the healthcare system is not meant? My understanding is, a lot of people have the idea that the healthcare system is meant to keep us healthy, and I think most physicians, if you sit down and talk with them, they'll say, no, it's to help supplement. It's to help supplement and maximize our health.
I see where you're coming. There is a responsibility. As each of us has a responsibility to try to lead healthy lifestyles and to be responsible. I think, is that what you're getting at?
I am, and do you think that would help drive down some of the cost of?
Sure,
Okay.
Sure it would.
All right, thank you, Mr. Chair.
So you're saying that double cheeseburger and large fry and a milkshake I had for lunch yesterday was probably not the best idea? Is what you're saying?
No, I'm saying that sometimes people make a series of repetitive poor decisions.
I understand. Yeah. So if I eat it again today, that would be a repetitive series of poor decisions. I'm following now. Amen. All right, guys. Sharon, we appreciate you always being here. You do a great job and always tough questions. But this is like one of my co-chair said, there's a lot of hypotheses and some of the stuff that you're trying to look in a crystal ball and see what's going to happen. And you've got a lot of people that you're trying to figure out the crystal ball, and it changes by the minute. So we appreciate your work and always been willing to come to the committee and discuss these issues. You're always willing to talk to us, so we appreciate you very much.
Thank you, Mr. Chairman. Thank you, members. And whenever we can be of assistance, please contact us.
Thank you. We're ready for our next person to come to the table, Department of Financial Institutions. Marnie, it's always good to see you. Looks like you're traveling solo today. You can handle the table by yourself, so it's good to see you. Introduce yourself for the record, and we look forward to your presentation.
Make sure technology works first. So good morning, everyone. Thank you, Chairman Carpenter and Meredith, for inviting me to speak today. I'm always excited to talk about the annual update that we have for Department of Financial Institutions. And listening to all of Sharon's hypotheses, I am grateful that I do not supervise insurance right now, Sharon, wherever she went. So my update will be a little bit simpler today. So I'll just go ahead and get right into it so we can get to our double cheeseburgers and milkshakes and Halloween candy, which is my current downfall. All right, so I do like to talk about all the areas that we supervise. I think it's more effective so we can capture everything that we do. Maybe. There we go. Okay. So first I want to talk a little bit about our bank branch snapshot. And all of this information is available online as part of our annual report. So you can take a look at this. If this is too much information, you're too tired to take it all in this morning, you can always go to our website and check it out there. If you look at the numbers, you can see we do have declining numbers of banks. However, that seems to have leveled off a little bit. If you look at 2022 to present, we actually gained a charter in 25, and I am excited to say we have a de novo application, so I am hopeful we might hit that 100 mark again. I think that would be my goal while I am commissioner, would be to jump up to those triple digits again, so I would love to see that happen. The de novo is in process of application review, and I think we're hopeful that that will join our banks sometime in 2026, so hopefully next year I'll have a better update when I come. Number of banks under 100 million, those are still continuing to be, again, a little bit level, but you can see that sharp decline that occurred. And it's not surprising, as a lot of our smaller banks are experiencing the issues that you probably are aware of. The succession planning is always a problem, as well as just the location. If you're in a rural area and you're a smaller institution, sometimes it's harder to get that interest to keep individuals running. But I will say there is a lot of new excitement in the banking industry. And because of that, we see a lot of younger people that are excited to come back to the banking industry, especially in Kentucky. A lot of good push from that. So I'm excited to see that continue. Total assets have continued to increase. So while you see the number of our institutions decrease, total assets are obviously increasing substantially. So I'm happy to see that even after some of our uncertain economic times, there is still growth in that area, as well as growth in total loans. And now let's talk a little bit about asset size. So this was indicated a little bit by our previous slide, but if you look at this one and you see the charter count there, and again, this is more, the graph is a little bit more illustrative and helps out with this. The large number of our banks, if you can see the colors there, are going to be kind of in that middle range. So we do have several that are reached that 1 billion mark. That's going to be your top one. Obviously, much less in the under 100 million category, but the broad range of our banks are right in between that $100 million to $500 million range. Very much healthy community banks, which is what we are happy to see in Kentucky because they are serving our customers. And I'm very happy with the continuation of our community banks. And in fact, all of our charters are considered a community bank level, and something that, again, state charters only. I'm very happy to say that. And when I go speak at conferences and talk to some of our other surrounding states, we have a very good broad mix and have less of that kind of underserved population that you do see. We don't see that quite as much in Kentucky as I know some other states seem to, and most of those seem to be covered by our community banks. Let's talk about performance. I always say this is my favorite chart, and it continues to be my favorite chart because it really shows how Kentucky stands up to its surrounding states as well as the national average. And the one that I want to point out to you most is going to be the capital. If you look at our capital, Kentucky is almost always the leader in our area on capital preservation. So again, we are right at 11%, well above the national average, and you can see the closest one next to that is Virginia, just not too far from that. But again, Kentucky always does well in this area. And if you take a look at the net interest margin, return on assets, and return on equity, all of those, if they're just below kind of that highest range, and if not, they're at least above the median and always above the national average. So what that means is Kentucky takes care of not only its customers and its community, it also takes care of its shareholders as well. So they really have a good mix and balance for Kentucky banks. So I have nothing but positive things to say on this chart. And then this is just another chart just to help you take a look at the Kentucky bank performance. It really shows the trends over the years. If you look at the dips, those are really around COVID years, and that's when there was a lot of cash kind of pushed into the economy. We all knew things were a little bit different at that time. So we'll just kind of take that section out, and if you remove that, you can see the trends are pretty much, I don't want to say stagnant, that's not normally a positive word, but pretty stable. And now let's take a look at our credit union branch, or our credit union branch snapshot. We are down to 17 credit unions. We do expect to lose at least one more, maybe two by the end of the year, or at least in 2026, excuse me. Number of credit unions under 100 million are down to 10, and that is a majority of our credit unions. Total assets have decreased substantially because we did lose a large charter. And so because of that, our total assets are under $3 billion right now for all of those institutions. Total loans decreased. And it's not very often that I do say that the assets and loans have decreased. But in this case, when we lost the largest charter, it did make a substantial change. This chart, I know it's really colorful, but if you take a look, it really kind of helps explain kind of where things are in the credit union space. We have no credit unions under 10 million now. Those are all gone. And a vast majority of the credit unions we supervise range between 10 million and 50 million. So a very small section of the group. We only have a couple that are above that 500 million range, and the rest are going to be between 100 million to 500 million. So all but a couple charters are under that 500 million range, again, with the vast majority into that second smallest category, as we have none of the smaller anymore. And then let's talk about performance. So these are similar statistics, but not exactly the same. So if you look at the net worth ratio, West Virginia tops that, but you can see they only have 3 credit unions, so that's kind of hard to compare. But if you take out that piece, again, Kentucky remains near the top on that. Return on average assets, we're kind of right there in the middle. And for net interest margin, we are the lowest actually of the states in terms of net interest margin. And looking at this chart, I actually think that should be 25. Apologies, I just noticed that mistake. So if you take that is actually this year, so apologies for that, and I will get that corrected. But you should be able to see in the annual report. The one additional thing that I do want to add is that our credit unions do have a good history of serving their membership and paying healthy dividends on the shares. So that's why some of these, while they might appear a little bit negative, there are other factors that go into that. But capital protection still does remain a priority, and that's always important for any institution that we supervise, whether banks or credit unions. And then lastly, I want to talk about examinations. So we are on par for our normal number of examinations, and if you look at safety and soundness, we're at 42. That number just varies upon timing as well as the size of the institutions that we supervise. So because it was lower in 23 is probably just timing, unless that we weren't doing anything in 23. So just to characterize, that's why that number looks a little bit different there. Everything else is pretty much on par. And if we're looking at off-site visits or reviews, if those are down, that's because of less issues that we see. And then for visits, again, that could just be timing as well. Okay, and then now I'll move on to securities division. So in the securities division, our broker-dealer registrations are all pretty much the same. And if you look at the second category here, broker-dealer and issuer agents, these are going to be all the individuals that we supervise in that area. Those numbers continue to increase, and they have been increased as long as I have been with the department. And now they're up to about 175,000 as of year end. Investment advisors are about 1,500. Those are firms that are operating in Kentucky in some shape or form. And lastly, investment advisor representatives, those have increased again by about 500 or so. So we are looking at just over 7,000 individuals that transact in this state. Licensing and registration again. These are individual securities that we do regulate. If you look at mutual funds, those are down just a little bit, but that's pretty normal because these numbers kind of ebb and flow, and that depends on the number of new filings, renewals, as well as the timing. A lot of these do come in at the beginning of the year as well. So if we looked at that number today, it would likely be higher than it was at the end of 2024. Unit investment trust, just again, other types of securities. And to get us a little bit closer to lunch, I won't go into all the details on these, but again, these are just regular types of exemptions that we do review or take a look at in the state. So investments filings are pretty much stable, even though the numbers fluctuate just a little bit. If you look at compliance, I want to talk about our exams just a little bit. We're about the same level we were. We are in the process of training some staff when we really want to focus on those broker-dealer examinations. The reason that investment advisor examinations are the priority is because we are the only ones that supervise those investment advisors. The broker-dealers also are supervised by FINRA as well. So if the investment advisors or the state-registered investment advisors are not looked at by us, then they're not looked at by anyone. So that's why investment advisors are typically our priority, just to make sure somebody is in there taking a look at them for consumer protection purposes. Enforcement. So much like Sharon, I can say that we have had an influx in a different way. She talked, or Commissioner Clark, I apologize. Commissioner Clark did talk about increase in fraud. We are seeing that as well. So if you look at the number of investigations open, we opened 132 this year versus 20 last year. That shows you the number of complaints that we are receiving. Lots of referrals. We were at 71 last year. That is the highest number that I have seen since I've been with the department, which is about 17 years now. And all of that, I at least touch securities in some respect, and you can see those numbers. Administrative orders there, we were at 12 of those. Law enforcement investigations, we always have a few of those ongoing as we work with our county attorneys as well as the federal government in various capacities. And I do want to look at the restitution there. You can see those numbers. Those ebb and flow based upon cases. Sometimes we have none, sometimes we have a lot. And we had quite a bit in 2023. That was from multi-state cases. Same thing with 2024. That 3.3 million you see comes from multi-state cases, which is really a good thing because that is helpful as we work with other states. And in addition, we are able to work with the industry, and sometimes easier if you're going into a settlement to work collectively with all the states at once versus one state 50 different times. So that's why we do like those multi-state cases. Unfortunately, though, some of those have been, they tend to be more fraud than anything. And those cases right there in particular involve fraud, and that's why the amounts are so large. And then lastly, I want to talk about our non-depository institutions. This is where the vast majority of the different areas we supervise fall. This is where mortgages, consumer lenders, deferred deposit, which are commonly known as our payday loans, our money transmitters, and our student loan servicing. So all of those areas do fall under non-depository. If you look at that, again, same thing. We're looking at licensing numbers. Loan originators up a little bit, and money transmitters are up a little bit. You see brand new numbers there for student loan servicers. That's because those just went into effect in 23, and we finally got all the rules and everything in place in 24. So we took those first applications there. So that's why those are brand new numbers there. Again, all pretty stable. And examinations, we did a few more examinations of mortgage companies, and I can say we are doing even more in 25, and we are starting to do more in that multi-state joint examination space because, again, it makes things a little easier for everyone. Mortgage broker exams also up there. A non-mortgage examination, deferred deposit, those numbers will continue to go down as our deferred deposit lenders are continually decreasing in the state because of the moratorium on any new licenses. Money transmitters, those will increase. Almost all of those are multi-state exams because we have very few multi-state or money transmitters located in the state. Those are all usually operating in other areas, and then we do those joint examinations as well to cut down on time and resources and to help everyone with a little bit of the cost. And consumer and industrial loan, again, about the same. It really just depends on the cycle. And then lastly, talk about the consumer protection branch. So you see, this is really just a breakdown of our complaints. A little bit more in the money transmitter space, internet payday loans, those again, like ebb and flow, pretty much with the economy. We tend to see those go up when we see a little bit of struggle in the economy. Other general scams, that could be any variety. And then if you look at the fines, I want to point that out as well because you can see that number is significantly more. That is, again, based on a multi-state. So it was a multi-state case. We had an over $200,000 fine for one of those, and that's why that number is so much larger. Okay, and I think that is all that I have, so I am happy to answer any questions, to jump back to any slides if there's anything in particular, and then my office or me, any one of us, we're always available if you need to reach out and just have other questions, or if you have constituent concerns, we try to help with those as well.
Commissioner, I think you've done a good job. I don't see a whole lot of questions. Senator Howe, he stepped up to the plate.
Good, I need one. That,
Yes, right.
that means you all were all asleep if I had no questions.
I see it.
I
Senator
didn't
Howe.
want you to feel left out.
Yeah.
Thank you, thank you.
You had mentioned in there that last slide. It had you don't have to go back to it.
Okay.
About there was a huge increase in the internet payday investigations. That number went from a single-digit number to 30 something. Is that unusual to see that kind of jump in any one category like that? And do we know why that happened? Is it just us, or other states, to your knowledge, experiencing a similar problem with internet payday?
So I can't speak specifically for other states, but I would assume the answer is yes, and I'll tell you why. Because that jump is certainly not uncommon, and it usually is in times when the economy may be a little uncertain. People tend to go to those internet payday lenders, and some of those are tribal lenders, and we have no jurisdiction over those whatsoever. Usually that's the vast number of complaints that we get is from an internet payday loan that would have been unlicensed in some way, shape, or form. And I've noticed, if I remember, and don't hold me to this, but if I remember around 2018-19, those numbers were pretty similar to what you saw there. So again, they would kind of go down for a little bit and then they might ebb up. So we didn't have many complaints during the beginning of COVID when there was a lot of supplements and influx in cash, but I think we're starting to see more of those again, and they too do tend to take a little bit more time to kind of come out, so to speak.
Sure.
And so by the time that rolls into a complaint, it's probably been a year or so when someone's still dealing with those issues that we get that complaint.
This comes with general economic trends.
Yes, that's how I would characterize it.
Great. Thank you. Thank you, Mr. Chairman.
Thank you.
Thank you, Commissioner Gibson. We appreciate you being here today. And if anybody has questions, your office, as always, does a great job of reaching out to us and getting that information to you. So we appreciate you being here.
Absolutely. Thank you all so much.
Thank you. We'll keep on moving. Our time has kind of got away from us a little bit, so we'll try to catch up if we can. The next group is our insurance industry update. I think we got Chris Nolan in a group there with Chris. I'll have them come to the table, introduce yourself for the record, and we look forward to your all's presentation. We'll keep it as concise as we can. I know you guys will do a good job of that, and we'll kind of keep our train on the tracks here.
Push it. Morning, Mr. Chairman. Matt Overturf. I'm the Assistant Vice President of Affairs on behalf of the National Association of Mutual Insurance Companies.
Chris Nolan, Executive Director of the Insurance Institute of Kentucky.
And Lisa Pierce, Legislative and Regulatory Counsel for Allstate Insurance.
Thank you all for being here. Please proceed.
Thank you. So I'm going to quickly kick things off, and then I'll turn it to Chris. So first I want to introduce NAMIC to the committee. This is my first time at the table officially. So NAMIC is the largest property and casualty insurance trade association in the country. We have over 1,300 member companies. We support regional, local mutual insurance companies as well as some of the country's largest national insurers. In Kentucky, NAMIC members write 73% of the homeowners insurance market and 64% of the private passenger auto market. I was given the task of giving a state of the industry this morning, so I'm going to do my best to keep it under a few minutes here. So since inception, the property casualty insurance industry in the United States has concentrated on helping policyholders find ways to identify, minimize, and mitigate risk. Property casualty insurers exist to protect policyholders consistent with a legal contract that governs the terms to providing coverage, protecting homes, businesses, and automobiles from financial loss. Property casualty insurers continue to find themselves challenged by new levels of claims, which include an increasing frequency and severity of costly disasters, lawsuits, and other events. Together, these realities have driven combined ratios to over 100 for many companies, meaning that between claims and expenses, they are paying out more than they are taking in premium. So some Kentucky numbers for you really quick. Across the industry, I have the 3, 5, and 10-year average on combined ratios. So the 3-year is 121.6, 5-year 116.6, and the 10-year 104.2. And so each of those scenarios, insurers are paying out more in claims and expenses than they're taking in premium. It's not all doom and gloom. 2024 was a slightly better year with insurers coming in right around the break-even point, both nationally and in Kentucky. However, those high combined ratios on the 3, 5, and 10-year remain. In light of these ratios, availability and affordability concerns have been raised across the country. And there are 4 consequential developments facing the property casualty insurance market as industry works to adapt to what we refer to as the new era of risk. And those 4 areas are extreme weather, economic and inflationary pressure, cost drivers, and legislative regulatory overreach. And I'll spend just a few minutes touching on all 4 of those. So in the extreme weather, while weather challenges are far from unfamiliar territory for insurers, recent increases in the frequency of extreme weather events accompanied by inflationary pressure on materials and labor needed to repair and rebuild, pose new levels of difficulty for carriers providing coverage. More severe convective storms, tornadoes, hurricanes, and wildfires significantly complicate carrier efforts to help policyholders rebuild after an event. So what can be done? While insurers, legislators, and regulators cannot stop weather, the focus is on areas to better understand, support, and fund mitigation and resilience efforts. It is essential to see meaningful risk reduction at scale when it comes to learning how to live with the changing weather. This requires strengthening the built environment through an adoption and enforcement of the most modern statewide building codes and support for various mitigation and resilience efforts. A data point for you here, $1 in pre-disaster mitigation saves $11 in future disaster cost. With respect to economic and inflationary pressure, insurers face the same macroeconomic issues as everyone else. We are not immune to that. Inflation shows up in everyday insurance prices. When it costs more to put a house back together after a storm or repair a car after a crash, insurance costs go up with them. Insurance tends to lag other industries in terms of responding to changes to the market conditions due to the retroactive nature of the business, as premiums collected today are to cover losses of tomorrow at tomorrow's prices. So what can be done here? Maintain rate flexibility for insurers. Kentucky is a fluctuating state, which means insurers can generally use and file modest rate adjustments up to a certain percentage, beyond which requires prior approval by the department. This allows insurers the ability to react to changing market conditions in a timelier manner. In addition to rate flexibility, maintain and continue to take actions to attract and retain capital in the state to further incentivize a competitive market. The third bucket is cost drivers. And I pulled a couple examples here. So insurance fraud is obviously a big one, and Commissioner Clark touched on this quite a bit, but I'll just reiterate. Annual losses from insurance fraud are estimated to be over $308 billion. Kentucky, you all and legislators across the country have taken significant steps to reduce insurance fraud by strengthening statutes for various fraudulent acts. However, as we already heard, the next step is enforcement and prosecution of those acts. More can and should be done to increase the enforcement and prosecution of insurance frauds to better address this cost driver. Another significant cost driver is inflated billing. So inflating costs simply to increase the claim payment damages puts upward pressure on liability insurance rates. In this way, all insurance rate payers subsidize higher jury verdicts and settlements. States should focus on efforts to attract insurance capital into their marketplaces. In making determinations on where to invest new capital, insurers look at things like expected loss costs. Inflated billing, including in phantom damages, towing and storage fees, tree removal services, and etc., contribute to the future loss costs and invariably affect decisions on where to adjust rates and write more policies. The third cost driver is legal system abuse. So the origins and causes of legal system abuse have been around for several decades. While they may have operated in a separate vacuum or silos in years past, in the new era of risk, these abuses have systemically and concertedly whipped many legal hazards into a cost-causing storm within the legal community. This is not a result of a single action, but a confluence of developments. These systemic challenges have a direct financial impact on households across the country. So addressing cost drivers is actually one of the areas where legislators and regulators can have the biggest impact. Help insurers navigate the new era of risk in states by reducing cost drivers in the market that allow for a downward pressure on the insurance prices by enacting reforms to eliminate or reduce various cost drivers in the market. And finally, legislative regulatory overreach. The insurance industry is already one of the most heavily regulated industries in the country. Property casualty insurance regulation has traditionally been left to the states. But as insurance discussions become more mainstream, many legislators and regulators are seeking more involvement into the business. Legislative and regulatory overreach can lead to duplicative work and increased costs that can hinder insurers from accomplishing their core mission to keep their promises to their policyholders. And this is actually one area where I want to give both this committee and the General Assembly here in Kentucky a lot of credit. As you all have worked with the industry and stakeholders over the years on many of these issues and resisting what we refer to as the do-something-itis that we see in many other states. So to conclude, Kentucky is critical to the well-being of the U.S. economy, given the role it plays in a variety of sectors. For these sectors to work efficiently, the insurance markets need to work well. That's why we're appreciative of the opportunity to share some ideas on how policymakers can take steps to lower cost drivers and improve the state's insurance market to continue its vital role in the well-being of the U.S. Thank you.
Thanks, Matt. Appreciate that overview of the property casualty insurance industry. And I'm going to touch on a few things. Commissioner Clark mentioned them as well. But, so what have we done over the last few years as an industry and as a legislature? What have you all accomplished for the industry to help address some of these pressures? Working with this committee, the industry has pursued mitigation efforts, many of which are in the implementation stages still. So we're still waiting to see some of the results through fewer inflated claims and more efficiencies in the system. But the last couple of years have been aggressive and been productive for the insurance industry. Started with kind of creating a fortified home program that will provide incentives for homeowners to build and repair their homes to fortified standards designed to better withstand natural disasters. And Kentucky is not the leader in this effort, but it's one of the few states that are leading in the fortified home program standards. We did legislation specifically addressing contractor and roofing fraud, mostly by out-of-state contractors and fly-by-night repair schemes. We passed legislation to expand the definition of a fraudulent insurance act to include inflated billing practices. We addressed auto repair and other fraudulent acts through the limitation of the assignment of benefits and clearly delineating repair practices when it comes to auto glass repairs. The licensing and regulation and monitoring of public adjusters to ensure they're acting in the best interest of consumers. Legislation to help continuing the ongoing battle to combat inflated towing and storage fees. That is a huge cost driver for insurers. Passing legislation that will create an electronic real-time insurance verification system to ensure every driver maintains vehicle insurance. Passed legislation creating a voluntary paid family leave marketplace that is still developing here in Kentucky, and streamlining a better framework for insurers to pay settlements with minors. That's just to name a few. And many of these pieces of legislation have become leading policies around the country, as I mentioned earlier, and have subsequently been adopted as national models by the National Council of Insurance Legislators, otherwise known as NCOIL. And we keep talking about NCOIL models. We pass a lot of them, but we also pass our own legislation that then becomes these important models for all the other states to look at. And that's been very important for Kentucky. But as it's been alluded to, there's a lot more that needs to be done. We plan to renew efforts to combat PIP fraud and abuse by applying the workers' comp fee schedule to the PIP medical claims. We made tremendous progress on this last session and hope to continue that work again this next session. That will be a high priority for our industry. And then it's been mentioned a couple of times by both the commissioner, by NAMIC, the litigious landscape that continues to be a huge cost driver for Kentucky businesses, not just property and casualty businesses, but all businesses. And we need to do more to control those costs for all kinds of insurance, and we're going to have to address the need for lawsuit abuse reforms in the near future. And finally, it's been mentioned as well, more prosecutions when it comes to once these fraud has been identified, is to be able to prosecute that. So I'd like to now turn it over to my colleague at Allstate to briefly discuss a consumer protection issue for this next session.
Thank you, Chris, and thank you for the opportunity to speak today on behalf of Allstate and the IIK membership. I'd like to bring your attention to a consumer protection issue arising from the current interpretation of Kentucky's insurable interest statute that comes into play when vehicles are deemed a total loss. As it stands, insurers are required to remove a vehicle from a policy on the date the company takes title, which is typically when the vehicle is declared a total loss or shortly thereafter. Now, removing the vehicle from the policy has adverse impacts to consumers with single vehicle policies. And for context, at Allstate, 30% of our entire portfolio is comprised of single vehicle policies. So this means basically that when you remove the vehicle from the policy, you in effect terminate the policy because there's nothing left to insure. And when that happens, the person whose vehicle is totaled is left without uninsured motorist coverage if they had it. They have no coverage if they want to borrow someone else's vehicle to drive it. And they may not have any rental coverage that extends at that point. And if they do have rental, they may have to pay more for certain coverages. So another issue, which is potentially the most devastating, is that once you have a gap in coverage or a lapse in your coverage, if you go out to secure another policy of insurance, it will likely cost you far more because many companies actually rate policies at a higher premium when there has been that gap or lapse in coverage. Now, this is a practical problem for Kentuckians who have just suffered a loss and find themselves without coverage at one of their most vulnerable moments. The Insurance Institute of Kentucky hopes to work with the Department of Insurance to explore regulatory solutions. However, it may be necessary to file a bill to tweak the insurable interest statute, specifically to allow coverage to continue for a short, defined period of time after the insurer takes title. This would give consumers time to secure a replacement transportation and maintain their essential protections. We believe this is a modest, targeted change that aligns with the original intent of the law while better serving Kentucky consumers. Thanks so much for your time, and that's the end of my prepared remarks. I'm happy to take any questions.
Thank you all very much. Did you have one, Meredith? I think I had a question from Co-Chair Meredith.
We have talked about that insurable interest piece just a little bit, but for the committee, what would you all envision as far as that time frame to try to adjust to make that workable?
So we've not had any internal discussions about that, but honestly, if I were just to throw out a number this morning, it would probably be 30 days. I mean, these people, you know, if your car is totaled, if it's an older vehicle, it could be a minor impact, but if it's a newer vehicle, if you total your car, there's a significant likelihood you're in the hospital, you've got physical injuries that you're dealing with, and clearly your health is your first concern in that situation, and your car is secondary. So allowing time for consumers to be in a position where they can actually look for a replacement vehicle, I think 30 days would be an awesome time frame, and also allow those people that are under-resourced time to do the shopping that they may need to do to find something within their price range and budget.
Thank you.
You're welcome.
Thank you all. Any other questions or comments from your group?
I think we've covered it. We appreciate the time this morning.
All righty. Any other questions from the committee? Looks like we're good to go. Appreciate you all being here. Our last presentation for today is the credit union industry. If you guys would like to come up, and ladies, I think I saw some folks there maybe, would come up to the table, introduce yourself for the record, and we'll have an update from your all's group. Haven't had you all in this year, I don't believe, so we look forward to your presentation, and introduce yourself for the record. And keep it pretty precise. We got 15 minutes, I think, so it should be enough to take care of what we need to do here.
Baton cleanup.
That's always good.
Hey,
Thank you all.
Good morning, Jim Cash. I'm the president of Kentucky's Credit Unions, the trade association here in the state.
Jason Suman, president and CEO of Members Choice Credit Union, located in Ashland, Kentucky.
I'm Ray Springsteen, president and CEO of Abound Credit Union. We're based in Radcliffe, Kentucky.
I'm Kyle Haggerty from Kentucky's Credit Unions.
Thank you all. Please proceed.
Great.
Good to see you.
Nice to see everybody. Thanks for having us this morning. Co-chairs, members of the committee, thanks for the opportunity to appear to bring you up to speed on what's going on with Kentucky's credit unions. As you are aware, credit unions are not-for-profit financial cooperatives. We are owned by the very people we serve. Our members are not just customers, they're our owners, and every decision that we make is with their financial well-being in mind. Credit unions return all of their earnings directly to members in the forms of lower loan rates, higher savings yields, reduced fees, and by serving those Kentuckians who may have no other access to the financial market. Our mission is simple but powerful: provide safe, affordable, and accessible financial services to Kentuckians from every walk of life. That cooperative, not-for-profit structure is the difference maker. It's what allows us to do things that other financial institutions often cannot or will not do. When a member comes to us for a loan, our focus is not on maximizing returns to out-of-state shareholders, but on helping that member achieve financial success. That difference explains why credit unions are so beloved by their members and valued in their communities. And again, any net income flows back to the people in the communities we serve rather than as profit to shareholders. There's nothing wrong with profit. It's fueled innovation and growth in many industries. Credit unions are providing a healthy, member-focused alternative that ensures access to affordable services, particularly in rural communities and among families who might otherwise be left behind. I'm sure you'll agree that Kentuckians deserve options and financial services just as they do in other areas of their lives. I know last month you heard from the Kentucky Bankers Association at last month's committee meeting with the refrain about our alleged tax advantages from our not-for-profit status. We just want to talk about that directly. Credit unions, as not-for-profit cooperatives, pay significant taxes and fees. Property taxes, payroll taxes, regulatory fees, and more. We fund our own regulatory agency and deposit insurance program. And throughout our history, credit unions have never once been bailed out by taxpayer dollars. In fact, in the most recent tax year available, Kentucky credit unions generated over $106 million in tax revenue through their economic activities such as contracting employees, purchasing, and credit union employees spending in the local economy. But as not-for-profit cooperatives, credit unions don't pay taxes on their deposits or their earnings. And that makes sense because every dollar of earnings is returned to the member owners, the Kentuckians who belong to credit unions. Pardon me. The KBA would have you believe that this tax status is the reason banks can't compete with our rates and our exceptional service. That's not true. The deposit tax that banks pay is tiny compared to the earnings that they send to their shareholders. The real financial difference maker in this competition is what each type of institution does with their earnings. Banks send it to shareholders, whereas credit unions give it back to their members. Finally, independent economic analysis confirms that the financial benefit credit unions deliver to their members and communities through those lower loan rates, higher deposit returns, and fewer fees is immense and demonstrates credit unions' focus on reinvesting in their member owners and communities. For example, here in Kentucky, our not-for-profit member-owned credit unions delivered $173 billion in direct financial benefits to consumers in 2024. In other words, Kentuckians and the economy of the Commonwealth are better off with thriving credit unions, and our communities are stronger as well. Before we turn to a couple of legislative issues, I'd like to ask Ray and Jason to share a bit about kind of how they serve their members and communities.
Thank you. So we were founded on Fort Knox 75 years ago. Today we serve about 130,000 Kentuckians and military really throughout central Kentucky. A couple of interesting programs that we provide for veterans in the military. One's just happening in a couple of weeks. We provide a program called Veterans to Entrepreneurs. The idea is those individuals who are transitioning out of the military to be able to learn how to start a business in the community. What we do is we have a network of other veterans who have successfully started businesses that will provide training and networking. We also will have experts in business startups and then community and government community leaders really to help with building a network. But it's just an opportunity to learn and help those veterans who are interested in starting a business. Second, we invest in veteran and military-related education programs through Western Kentucky University and funding for Western Kentucky, and then also funding for ECTC, Elizabethtown Community and Technical College, and through USA Cares. And then last, we provide small dollar commercial loans. These are $100,000 commercial loans, really to help someone transitioning out of the military to start a business. And the idea is it's something that helps them with provide something for inventory, get the business started, and to help grow that business and really be a continue to support the community. And I think it's a neat program that we're offering to our military members.
Thank you for allowing us to be here today. Members Choice Credit Union is a $415 million financial institution located in Ashland, Kentucky. And I have a little bit of a different, unique perspective, I think, whereas I've been in the financial services industry for a little bit over 30 years. And 95% of that actually was in banking. So I was actually a member of the Kentucky Bankers Association, and just these past 2 years have been a part of the Members Choice Credit Union as their CEO. And the thing that I wanted to share with you is just from that perspective of knowing from a regulatory standpoint, the requirements that are there for banks are the same for credit unions. We go through the same examinations through the Kentucky Department of Financial Institutions. We have the NCUA, which is a federal agency that actually regulates us. So we also make sure that our members' funds are safe and sound and secure. The main difference that I found between banks and credit unions, not from a financial structure standpoint, not from one where the regulatory burdens are there, but rather the difference in what we choose to do with our funds, which is give it back to the members. It doesn't go to a specific group. It doesn't go to a specific family. It doesn't go to one or two shareholders or a group of shareholders. It goes to our members, and in my case, that's 24,000 members strong just in our 33 counties that we serve. So by doing that, we're giving back to the community, to those folks, and Kentucky gets to benefit from that. And we just really appreciate the opportunity to continue to serve our members.
At the risk of, it sounds like we're attacking banks. We're not. That's not it. We respect and recognize, a healthy financial services market requires all of these different types of institutions. There's on 98% of the issues we probably agree. There's just a few that we disagree on. And one that we wanted to bring up today is the opportunity for municipalities and public entities to have the option to deposit funds at credit unions. It's something that they disagree with on that. The state credit union statute for credit unions is crystal clear. To quote from 286.6, credit unions may act as a fiscal agent for and receive payments on shares and deposits from the federal government, this state, or any agency or political subdivision thereof. Back in February, the KBA wanted to take away that option. They sued the Boyd County Clerk and Members Choice Credit Union, saying that they were illegally depositing their funds there. The Boyd County Circuit Judge decided completely in the favor of the clerk and of the credit unions, saying that it was clearly the General Assembly's intent to allow municipalities to be served by credit unions. The quote from the ruling, excuse me, the actions of the defendants are authorized by KRS 286.6.07512. Thus, the actions in depositing the clerk's funds with the member's choice cannot be unlawful as it is authorized by statute. The KBA didn't appeal that ruling. We thought that might end it and we would just roll on as things were, but then Auditor Ball issued an audit alert letting municipalities know that it's still their stance that municipalities can't deposit funds at credit unions. And when we met with Auditor Ball and her team, she said this is just a long-standing belief that office has held, not necessarily her personally, but that office has held, and that it would likely take a Supreme Court ruling for them to change. So what we are asking for in this session is for the General Assembly to just kind of clean up the municipal statute, to simply comply with the long-standing intent and make it perfectly clear that municipalities can be served by credit unions. It's good policy for Kentucky. Municipalities deserve the same options that Kentuckians do. And competition is a good thing. Not to mention that in some rural areas, the credit union is kind of the only option. So that's the ask that we have. I don't know, Kyle, if you want to add anything.
No, I'll just let Jason.
Oh, Jason.
Yeah, I'd be happy to. So as Jim mentioned, earlier this year, we were sued by the Kentucky Bankers Association as well as the Boyd County Clerk's Office. And we knew that the statute stated that we could accept public funds, and we knew that the Kentucky Department of Financial Institutions was good with us accepting those public funds, and we also knew that the NCUA was good with us accepting those public funds. And we're glad that the judge ruled in our favor, saying that we could maintain those funds and the Boyd County Clerk could keep his funds in our institution. I think that we just want to continue to be able to serve those municipalities if they ask. We didn't send out a request for proposal. We didn't call on them. They came to us. They were with a bank prior to our institution and had unfavorable results. So they sought out Members Choice Credit Union and wanted to see if we could help. And we were actually able to offer better returns on those funds, and we were able to give them a situation where we could offer better service. And for the past several years, They have been within our institution, and everything has been satisfactory, and they enjoy utilizing Members Choice Credit Union. And again, we offer the same type of insurance. We have NCUA insurance, which is basically the same type of limits as FDIC insurance that banks offer. We also offer ESI insurance, which is extra share insurance, which we can take that up for any of our members. And then we can also offer FDIC insurance, which banks carry. So from a safety and soundness perspective, which I know that has to be the most important item, is the money safe? Is the public money safe in your institution? Absolutely, without a shadow of a doubt. I can tell you from being in banking and credit unions that it is as safe in our institution as any other.
Yeah, I'd say if public entities come to our credit union, or really any credit union in Kentucky, really for a couple of reasons. One, we're local. Two, we are the money is insured, and then third is just for the best return. And for our work with public entities, that has been the reason for all the years that it's valuable to have the option for public entities to be able to use credit unions.
Scoot this over here a little bit for me. We had to add a chair. Thank you. I'll pivot to one more issue. We'll try and be efficient and get you all out before lunch. One other issue we heard about last month from the Bankers Association. They mentioned that they would be pursuing legislation to affirmatively ban the ability of a bank owner to sell the bank's assets to a credit union. Essentially, these are private transactions between a willing seller and a willing buyer. And I know this General Assembly's worked very hard over the last few sessions to pursue pro-growth policies and done a great job and made great strides there. And I think if you're a business owner, adding new limitations on who you can or cannot sell your business to doesn't align with that. Some statistics, in the last decade or so, 99.7% of bank assets that have been sold to other banks. So it paints a picture that it's not a super common occurrence that a bank chooses to sell its assets to a credit union. But while rare, when this does happen, it's a great thing for the account holders, for the communities, for the employees. Over and over, when these transactions happen across the country, the former owners of the bank always say they've chosen a credit union to sell to because they will keep the employees employed, it will keep the branches open, they will continue serving the local folks who they've cared about for those amount of years. And like we've said, credit unions are not-for-profit cooperatives. Their earnings are returned to their members, and those former bank customers are now member owners who will benefit from the lower rates on loans, the higher rates on savings, and extending services to folks who may not have access otherwise. So we just ask that the General Assembly essentially not support such a ban. But happy to take any questions, and thank you for the time.
We appreciate you all being here because it's an issue that has some members may have not heard yet, but I'm sure they will hear. As I've heard, I've got plenty of phone calls about it. It's an important issue that matters, and we want to make sure that we get it addressed right and handled the correct way, and make sure we kind of, like I've told you guys, we want to get the parties involved and communicating together to make sure that all members that are up here that are engaged and involved in this process understand, how it's going to affect everybody, help them make the decision that they think affects their community best, so we can make the right call. We do have some questions. I've got Representative Grossberg, I think, has a question or a comment.
Yes, thank you, Mr. Chairman, and apologies for coming in late, and I'm going to have to leave in a minute because I've got another committee. Kyle can attest to the three of you that I am a huge fan of credit unions. He and I have spent way too many hours on the phone talking about credit unions one way or the other. I personally use them. I advocate that others use for them. The issue that you just brought to our attention is actually new to me, but that's one of the benefits of being in the minority party is that they come to us often last on bills. But my ask/public request is that with all of the benefits that are given to credit unions that banks aren't afforded, which gives you guys a competitive advantage, please remember that all the same rules and policies apply to you. This is not an accusation to any of you. I use Commonwealth Credit Union. I'm very happy there, but there's another credit union that I'm not going to name that does very willful and deliberate redlining and excuses it as not redlining because they say they're not discriminating based upon the zip code itself. They're discriminating based upon the fact that certain zip codes have higher crime and higher vacancy rates of apartments. Tomato, tomato, that is still redlining, so I'm just putting it in the record and asking that you all make sure that your credit unions don't discriminate loans on the basis of the crime rates and vacancy rates of a zip code, because that is still discriminating against a zip code. Thank you. That's all I had. Thank you, Mr. Chairman.
Senator Elkins.
Thank you, Mr. Chairman. Thank you for your presentation today. My question first is for the gentleman from Member's Choice, I think it is.
Yes.
I suppose it's either Boyd County or City of Ashland one that's using your
Yes, the Boyd County Clerk.
Okay.
Kevin Johnston's office.
I've read the ruling that the judge made, and I thought he was pretty clear in his interpretation of legislation and the law. And I understand that there was not a ruling, but an opinion by the auditor's office that we've always done it this way, kind of thing. Did the Boyd County Clerk maintain funds in your facility throughout and still today?
Yes. Yes, he still has his accounts with us today.
Okay, thank you.
Yep.
Thank you, Mr. Chairman.
That answered that question, Senator Elkins. Well, like I said, we've talked about it. I've worked at a bank 15 years. I'm involved. I owe banks enough money, so I'm involved enough on all my business transactions on a few boards. So we're working with this group. We're working with the Kentucky Bankers Association to make sure that we kind of address this the right way. And kind of, as a banker, we always heard all kinds of conversations about didn't have paid the taxes, and we talked about that being a competitive advantage. And I'd asked you about where did you work before, and that you told me that your years at the bank, and I think that was a great experience, and our conversation kind of helped understand some things. So I look forward to this process, and that's kind of why we wanted to have you all come today, so we can get members that are involved in this committee that hadn't heard of this conversation for it to be brought to their attention, so we can kind of start the process of talking about it and give the KBA the conversation to bring you all to the table. And I'd ask you all, I think it'd be good for you all to have some conversations, and I do that. You can look around the room here for the people that are still involved. I've had several of the people here that are lobby and have conversations. Have them have some tough conversations between parties that may not always agree on some topics, but that's how we kind of get some of the sausage made that we can all tolerate and eat sometimes. If it's easy, it's most of the time not the good stuff. So we appreciate your all's testimony and presentation of this, and we look forward to working as session comes on. It's hard to believe session will be here for too much longer. Was there any other comments or questions you guys had?
Just thank you for the time and the opportunity, and we're always willing to engage with you all or anyone else. So.
Absolutely. I don't think I saw any other questions from anybody on committee. Announcement for the next meeting is November the 4th. Wow, is that our third meeting for the interim, huh? What about that? November the 4th at 9:30 a.m. in this same exact room. And so with that being said, we appreciate you all's testimony. We appreciate you all being here. Do I have a motion for adjournment?